Just earlier this week, Jim Cramer was saying that he was very worried about his Microsoft position, literally saying, "I'm very concerned about owning Microsoft and thinking that perhaps I should sell some, if not all." Maybe this is a contrarian indicator that it's time to buy, because that's what the insiders are doing. You look at a director at Microsoft, and he bought recently nearly $2 million. This is from an Insider IQ report from Flash. And so I'm looking at this and I see that Microsoft stock is down around 15% year to date. And it makes me wonder, is Microsoft cheap? And what are the reasons that the stock is coming under pressure? So we're going to talk about Microsoft's business model, and I think some of the key challenges, concerns investors have as there is a transformation that is going on with the business right now. My own personal conclusion is that I'm not likely to pull the trigger on Microsoft because, frankly, I think there are better plays out there. We'll talk more about that in just a second. If you enjoy educational investing content, please make a point of hitting that thumbs up, hit that subscribe button. So as we look at Microsoft, understanding, what is this business? First of all, it's amazing. I mean, in the most recent quarter, they generated over $80 billion in revenue, growing 15% year over year. I mean, for a trillion-dollar company, multi-trillion-dollar company, to still be posting this type of growth, teens growth, it's just frankly impressive. And it's spread across three different segments: productivity and business processes. Think about the Microsoft Office suite, LinkedIn, Dynamics 365, that's enterprise software. Then you have their intelligence cloud, which is Azure and various different server products. Think about the AI, infrastructure that's getting built out. And then more personal computing, which is the Windows, gaming, Xbox, and search, Bing. And so as you look at these different drivers, recognizing that it's really been split up into these three different segments, the reality is one of which is more than half, however, of their profitability, and that's the productivity and business processes. So the tools businesses and consumers pay to handle email, documents, collaboration, enterprise software. That is, in the most recent quarter, over $20 billion versus their consolidated profitability of around $38 billion in operating profit. So it is important to recognize one segment. Not all segments are created, equal. The productivity and business processes, that's over half of their core profitability. The next key driver, which is over a third of their business, is the intelligence cloud, where Microsoft earns, once again, from selling server infrastructure, cloud hosting, the AI data services to businesses and developers. Think Azure and SQL Server solutions. And then the last bit, which is, shy of 20% of their business, it's the Windows licensing, the Xbox gaming, Surface device, and, advertising, which is predominantly Bing. And you could see they break it up into the individual product lines here. You can't see the dollar figure, but you can see how they're generally trending. And you can also just tell that this business, it's not the Microsoft of 20 years ago where, let's say, the Windows licenses are driving the business. Now that's only 1% revenue growth in the most recent period. What's really driving this business is AI type of obligations, and we'll talk about that towards the very end of this video, but also their cloud just growing at incredible rates. Microsoft Cloud, their Microsoft 365 products growing somewhere between 17 and 29%. Even LinkedIn, a social network site, growing over 10%. Dynamic 365, so the enterprise software, growing around 20%. So overall, very impressive. Azure growing closer to 40%, so clearly taking market share. Xbox, there's going to be titles, this is going to be hit or miss, but it does reflect that, that more personal segment is sort of struggling, while the cloud is dramatically doing well, as are their core software solutions. So this is it's an interesting, story to see. But then you're starting to ask yourself, well, okay, so why is the stock under pressure? Why is Jim Cramer concerned? And I think there's a lot of, different dynamics that it's important for investors to be aware of, because I think the company's going through the equivalent of a phase change. Previously, it was this very high return on invested capital type of business, very capital light type of business. You don't need to reinvest a lot into it. Whereas now you're looking at a business where that free cash flow is declining significantly. And you can see it here. You can see how their operating cash flow, that keeps growing, but they're investing for this AI revolution. And you can see how between the dividend that they're paying, which is around $7 billion in the most recent quarter, and the capital expenditures, which was around $30 billion, they're actually tapping out their cash flows. So their earnings that they're reporting, which is much higher, it's not available, let's say, to go to the shareholders via, repurchases and dividends. You can't, let's say, dramatically start buying back stock when you have this level of investment. So I think that is the first aspect, which is that the free cash flow here is declining on a year-over-year basis. Now, some investors might say, well, Daniel, don't worry about it. It's a relatively short-term investment. But I think investors, this is part of the bigger uncertainty of, will Microsoft get the return on this massive investment, or could it lead to an overbuild? There is this uncertainty about, hey, we're building this to meet this demand, but will we get the economics that we want out of it? And it's also fundamentally, as I already mentioned, this is a different company. Just a couple of years ago, their capital expenditures for the year was sub $30 billion. Now in one quarter, it's closer to $30 to $40 billion. So this is a dramatically different capital intensivity type of intensive business. And so when you have that type of change where you have to take your cash flows and redeploy them into physical assets, it might warrant a lower multiple, because there is that less certainty about, will you get an attractive return on that capital that you're investing. So there is more of that element. And also, when you have a lot of free cash flow, well, let's say when every dollar of income translates into free cash flow, you can then take that and reinvest it in, let's say, you could do repurchases or dividends. And so you could say, hey, I'm still growing at this great clip, but it's 100% free cash flow to you. And I'd argue, I have no problem buying something at the valuation that Microsoft's at, which I'll talk about in a second. But I prefer that if I'm going to do that, the cash flow is actually going to me versus making this, monumental investment in what I'd argue is revolutionary technology, providing this AI infrastructure. And I'd say the last component of why Microsoft has come under pressure, in addition to the uncertainty of the economic return of their AI investments, combined with just the general phase change of Microsoft from this extremely capital light to an extremely capital intensive sort of business, is also the uncertainty that, hey, when we originally started talking about this, we were saying, hey, one segment is over 50% of their profits, and it's their software, and it's, their Microsoft Office 365 suite. And it's a traditional software as a service type of model, very high recurring revenue margins, very high margin type of business. But then, if you're going truly into an age of agentic AI, will people still need this full suite of Microsoft products? Is it possible that you don't need as many seats? Is it possible that, the AI models themselves use open source solutions that then completely cut out some of these things? And it's possible the whole workflow nature of various different jobs change in the years ahead as you get very smart AI. I view this as more of a uncertainty in the years ahead. I don't view this as an immediate threat, but this is definitely something that I think investors are concerned about, in the same way that software broadly has sold off in the last few months. Now, taking a step back, despite the concerns, I think it is important to recognize Microsoft still is an exceptional company. I mean, you can see is a company that's grown from $200 billion in revenue just a couple of years ago. Now it's closer to $300 billion. Its profitability is just amazing, where you're looking at $100 billion last year. This year it'll probably be closer to $120 billion plus. There are some questions about, hey, is it possible that all these investments you're making in these servers, is it possible you're not depreciating them at the right scale? And that's another part of the aspect that is the reason why Wall Street's penalizing Microsoft, is this expectation as you invest in all this hardware, you're going to have a depreciation schedule for it, and that's going to hit margins. And you're just starting to see that. You're just starting to see an impact to their margins. Once again, that's all part of that phase transition, going from that capital light, very, very high margins to, still going to be high margins, I imagine, but lower, because of, if you make an investment in a server and the useful life is only 5 years, you're going to have to write that off over time. And then you have some investors like Michael Burry saying, look at what Satya Nadella is saying, the CEO of Microsoft, and he's making the point that the useful life might be closer to 2 years versus, let's say, using a 5-year type of, accounting measurement, in which case maybe the depreciation schedule isn't appropriately accounting for sort of this new cash burning exercise of constantly having to reinvest in this infrastructure, in which case the earnings might take a 10 to 20% hit. So that's another angle that's causing pressure for Microsoft stock, is this assessment that your depreciation schedule on this infrastructure is going to step up. So overall, I look at Microsoft, I see the stock's down a little bit. It's still around a $3 trillion market cap, trading around 25 times earnings. That's around 120, let's say, billion in earnings this year, ballpark, versus, let's say, a $3 trillion market cap. So is that a buy level? You have Jim Cramer saying, hey, I'm worried. It's time to get out. What are my personal thoughts? As always, none of this is financial advice. I'm just sharing a little bit about my own personal investing journey. Also, Justin W., a premium member, wrote, thanks for the great content you've been putting out lately. I've really enjoyed learning from you about investing over the last 4 years that I've been a member. This follows Andre S. Since I've joined, my portfolio keeps on growing without me having to worry about it. If you're looking for compelling ideas, come check out Unrivaled Investing. I just made an exclusive video for my members at Unrivaled Investing that walks through a stock that I think that I have high conviction on, that I've recently been buying. So if you are interested, come check that out. If I turn to Flash, my free-to-use AI assistant, looking at any company in the world, its view on Microsoft, I think, is a little bit biased based on where it's historically traded, looking a little bit rear view mirrored type of driving, saying, look, the base case and high case, if you get sort of multiple expansion and continued, type of strong fundamental growth, you could have maybe 100 to nearly 200% upside potential over the next 5 years, whereas a low case scenario might continue to see some sort of, multiple contraction to around 18 times over time. But, going from, let's say, the 25 times now to 18, it's offset by the fundamental growth in this business. Now, I have this checklist. I use it on all my companies that I consider looking at. And frankly, most companies get out when I look at this. And let's see how Microsoft goes through it. Management alignment and obvious growth, I would say, are the two most important. Compelling valuation, sometimes I'm a little bit more flexible on this, but those two, this is ideally, I want all of it before I want to start buying. So the management alignment, you might say, well, wait a second, John Stanton, the director who's recently buying around $2 million, doesn't that mean alignment? Well, I also see that there's also been a lot of insider selling. Satya Nadella, even though he's an all-star CEO, he was just selling $75 million worth of stock back in September. So, it doesn't give this a perfect grade, in my opinion, when you see this type of dynamic. I would rather, say management alignment is when, hey, there's all this buying across the board, or there's multiple insiders saying, yeah, the value is so compelling. But when you have one and it's sort of small relative to the amount that's being sold, it's less compelling. So it's less of that sort of alignment signal that I like to see. That said, still, Satya Nadella, I'd argue, is a very good CEO and operator. So then, thinking about the growth potential, I think there are elements of obvious growth. You've certainly seen it with their Azure and their cloud clearly taking market share, which is important to see. And there is some more, channels for growth, such as their distribution mode, where you can say, well, wait a second, you already have hundreds of millions of people using Office 365. Can't you upsell them to use Copilot? And doesn't that turn into a rapidly growing premium solution that's, leveraging AI to make people's jobs easier and then actually increase their profitability? So that I would argue is the inverse to that concern I was talking about earlier, which is, hey, isn't AI going to disrupt all these jobs? Well, what about maybe it's about leveraging Copilot in the Microsoft Office suite, and that's now making everyone's jobs easier, and companies and workers are happy to pay up for it, to say, hey, this is a game changer to leverage these cutting edge models. We'll see. I would say there is that risk that it's going to be some sort of frontier model that, is going to completely disrupt things in the decade ahead. We'll see. I think another aspect that's giving investors pause is this slide from their recent earnings presentation, where management talks about, yeah, we have remaining performance obligations of around $625 billion. That's incredible. with a weighted average duration of approximately 2.5 years. So $625 billion over an average of around 3 years. So some of these obligations will carry out over a couple of years. Some will be, probably closer to 4 or 5 years. But in total, $625 billion, of which about 45% of this remaining performance obligation, this RPO, comes from OpenAI. So this does create the uncertainty of, well, if there's any sort of financing issues with OpenAI or the scale in which AI, the industry itself, doesn't scale, the way OpenAI expects or the way Microsoft expects, that is sort of the this is a big commitment, and clearly you're making that infrastructure bet with the expectation of satisfying this huge, $300 billion commitment from OpenAI. But that's the reason why they're investing in this infrastructure. So there is this risk of, well, what happens? OpenAI is a cash burning business. Yes, it's growing, one of the fastest growing, $100 billion company, and they just raised something like $100 billion. So they probably should be money good, at least for the next year or two, I would imagine. But it is it's a very dynamic space. And so you're looking at this as an investor as the company and the industry it operates is changing. There's more uncertainty. This isn't just rinse and repeat. You're going to sell more licenses and scale over time. You're looking at it as the industry might change. The way people do work might change. The capital intensity of this business is definitely getting worse. So you're looking at these across multiple angles. It's not surprising in my book, as I look at this, to think, not surprising at all to see Microsoft valuation come down a bit to around 25 times. I don't view that as super duper expensive. I view that as probably fair for the uncertainty that it faces. Now, I would prefer a company that trades at, let's say, 20 times and that can return all that free cash flow to you, because 20 times return all that free cash flow to you, is around a 5% yield. And then if you're still growing at 15 to 20% per year, then the fundamentals are growing. So there are those types of plays where, they're not, companies don't have to make this capital intensity switch where, their cash flow all of a sudden is getting absorbed by this huge project with uncertain economic returns. Overall, I wouldn't be surprised at all if this actually works out well for Microsoft. And I think, Satya Nadella is extremely thoughtful and prudent in terms of not going, let's say, crazy in terms of borrowing $300 billion to make a leverage bet on AI. I think they're going up to the all-in point where they're saying, hey, here's our cash flows and here's what we're willing to do, and let's make sure it proves itself. Let's make sure we've got that covered. I think investors would give a lower valuation if you crossed over. If you went from, we're at this level of free cash flow and now we're actually going to start cash burning for a few quarters. I think that would give investors pause, saying, hey, the risk profile of this company has changed. And then it possibly goes from 25 times to 20 times. So there are these dynamics at play. Personally, I think it's interesting that Jim Cramer's calling it out as something that he's worried about. I view it as they're making these investments for the future to drive the growth. I just think there are ultimately better plays out there that don't have this sort of the company is fundamentally changing, the capital intensity of this business is fundamentally changing, and I can find, you can find those types of companies if you turn over enough rocks. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.